you look over here, and since I started this portfolio back in October 21st, here you can see the performance date. I'm up 1%. And the great thing about M1 Finance is the fact that you can buy fractional shares of any company, any stock. And what I do when something is undervalued, when I look at something like, for example, Abbey, Johnson Johnson right now are and Pfizer are three of the stocks that I think that are extremely undervalued. So I mean, although this is a passive income portfolio, I mean you can see the name. It's called Alex Passive Income. I think the yield I think I have on this is about 3.7%. When I do, since I'm an active investor, I'm always watching the news. I know what is always going on with the headlines, the China trade war, the Brexit deal, whether there's going to be a deal, no deal, Hong Kong protests, impeachment inquiry. I'm always watching, but I don't overreact to it. I stay calm, and when I see a dip worth buying, you buy. So that's why it's so important to keep at least 10 to 30% of your portfolio in cash. So when you see moves like the I mean, we could come right here and go to the Johnson Johnson. Let's go to their details and check out their performance over the past week. Let's go 5 days. So I mean, actually, let's move to 1 month. So I mean, on the 17th of October, Johnson Johnson was at 136. Now here is where I think the FDA claimed that one of their baby powders gave a rare, I think it was asbestos or a rare, just a rare disease. And and then so the stock dropped about looks about 4 or 3%. Just, quickly, because I mean it's pretty bad news. You don't want to be in a company that does things like that. That when the like Jewel, like the whole thing that's going on with Jewel right now. I know there's over there. I believe 30. I'm not sure. I think 30 confirmed deaths that have been linked to Jewel, some type of Jewel. And I mean Johnson fell pretty low, and they kept trading around 128, 130. And when they tested their baby powder again, they went up 4% and back to their regular trading price. Now, I'm not defending Johnson and Johnson. I mean, I think their whole point is that they're one of the world's largest and most diversified healthcare companies. They come up with a lot of drugs. Now, I'm not going to get too much into their business because that's not what we're here to talk about. I mean, at the end of the day, I feel that most healthcare or pharmaceutical companies they do more good than what's bad. That's how I feel. I mean, Johnson has been around for years. I mean, if we scroll down here, let's see if it tells me when Johnson was first established. No, it does not. But it's just one of the companies that's been around for way too many years. And I mean, I knew, you do know that they have too many lawsuits. I mean, they have a expert team of attorneys that are working on these cases. So, although I think you would consider one of the riskier companies, healthcare companies out there. I mean, the whole point of this is if you would have bought down here, you would have bought the dip at 127, and the stock would have recovered. I mean, we could go back to 6 months ago, and it's the same thing. Dip in here. I mean, dip in May, and then a steady climb up to 141 in June. And same thing here in July with I believe this with the trade headlines, and it stays pretty low here. And now because the market is clinging on to what I like to call is false hope of a deal, the stock market goes up. And usually companies like this I think J&J is a Dow component. They follow the trend. So I mean, we could go here to the news sections. Today was the day that Fed cut rates again by a quarter point. Uh, Chile canceled the APEC or APCE, where the U.S. and China were supposed to meet, and probably I believe that they were gonna finalize that deal. Finally, that Donald Trump's been mentioning that they have come up with a deal, which we don't know anything about yet. I mean, today the Federal Reserve made a few comments. They said they're gonna basically what they said is that they're gonna leave interest rates the same for the at least for the next few months unless they see inflation prices hiking. I believe that's what they said. I mean, I don't. I mean, I don't. I think the Fed didn't need to cut. I mean, I understand why he cut. But I just feel like that's not helping us in any way. I mean, if the Fed keeps cutting, that just means that we're going into a recession. I mean, and then to turn our interest negatives like Donald Trump wants them to be. I mean, it's clear that the U.S. has higher interest rates than than most places in the world. I mean, most countries in Europe have almost no interest rate or negative interest rates. But so I mean, you could say that they're a little high. Definitely, you can agree with that. But let's get back to the topic. So the thing is, you buy the dips. The reason cash is so important is because you need to buy the dips. I mean, over these past I think 9 days since I started this portfolio, I already earned $1.76 in dividends in the past 9 days. Market gains are 48, but that's not really what I'm focused on. I'm focused on getting this portfolio right here to keep giving me steady income. And this technically would be my largest portfolio. My smallest would be this one in Robinhood right here. It's basically constructed of the same things. I mean, many companies here. I mean, my biggest position right here is Abby. I have an equity worth. I mean, total of 1,038. The return so far I have on it is 7%. So I mean that because I think Abby is just extremely undervalued. And then things like AT&T, Disney, and since this is a dividend growth, but also a value, I guess you could say grow high growth stocks too. So we have Uber and Smile Direct, which I actually paid a reasonable price for Smile Direct. I actually I bought when it was going down. I bought around 12. When you buy on the dip and then it keeps dipping. Yeah, it's kind of a painful moment when you think that you caught the stock at the deep end, but it dips a little bit. So I mean, after I caught it here, it dipped to 9. Now I'm not particularly looking to sell. What's really gonna change my opinion on this is what's gonna happen when they report earnings. I'm guessing what Wall Street mostly wants to see is revenue growth, just a lot of revenue growth and a lot of more users of their product. I'm guessing that's what we want to see. I don't know if there's any estimates to what Wall Street is expecting, but I'm pretty sure that's what we want to see. So I mean, these two would be right here high growth stocks because Uber is a company that I think is in a very exciting space, and I think that they're going to be able to perform well over the next 2 to 5 years. Same with Smile Direct. I mean, the idea. I mean, I love Smile Direct because they are the disruptor. They're the people that come in just like Netflix. They come in, they take market share because I mean it's so cheap, and I mean their services are more affordable than the mainstream. I mean, with Smile Direct, I mean basically I don't know if you don't know what it is. Basically, Smile Direct is a uh, I don't know what you would call it, a teledentistry, a global or turn. Okay, they basically make clear aligners. Basically, they you can either show up to one of their many smile shops or they'll send you a smile kit. So I believe that you buy it and then you do many bites and then you send it back and they send you clear alignments and you wear them for 6 months and they straighten your teeth. Now, and the cost of it is only around 1,800. I mean, you could say roughly 2,000, which I know it sounds like a big number if you're a person that has never looked into braces, but traditional braces cost about $5,000 or $6,000, and they're extremely uncomfortable that you have to wear all at the same time. Not only do you have to go to doctor's appointments, you got to pay for the doctor's appointments because apparently doctors charge you when you visit them. I have no idea why, but that's just how it works. Now, with Smile Direct makes everything simple. They come to your home, you buy it on a kit. They use the 3D printing to make you a clear aligner, and they send it right back to you. So I mean, I always believe that the disruptor is always the person to cheer for. Just like Uber. I mean, just look at the world. You know, everybody knows what taxis are. I mean, now no people don't use them as much. I mean, some places they're still there, but why would you go on a taxi when if you're a person that has a phone, you can download the Uber app, order yourself an Uber, and it's probably going to be at about 9, 20 or $20. I mean, besides a taxi that's going to take you like 10 miles, and they're going to be like it's going to be $44. I mean, Uber's just so much cheaper. I mean, of course they're not profitable. Neither is Smile Direct, but I mean, when businesses or disruptors first start, it's always it's always a struggle. You want to gain a certain amount of market share, and then you want to start cutting costs, or you want to keep growing. So I mean, the total account value of this one is actually 4,600. I use Robinhood Gold, which allows you to use an extra 1,000 on margin, but it's included in your $5 fee, so you don't pay any interest on it. So I mean, that's one of the cool things I love about Robinhood. The only thing that they don't have is dividend reinvesting. Kind of makes me want to switch my portfolio to M1 Finance. Kind of. It's just I mean dividend reinvesting is something that's really important for me. I mean I'm sticking around with them because I hope that in time they will be able to switch it. But reinvesting my dividends are gonna it's a big deal. You know that's what you want. You want to be able to reinvest your money into those stocks that it came from. Here I mean I have about three dividends pending. One AT&T, Abby, and Power Shares S&P 500 high dividend low volatility ETF. I have these dividends pending, and the thing is, I'm not going to be able to reinvest them. Now, of course, M1 Finance automatically does it for me. They'll invest the cash right back into these stocks right here, which M1 Finance makes a pie for you, and I mean after that you just go in there and you can adjust it to whatever your liking is. Mostly, I'm overweight. Here you can see that I'm overweight on healthcare because healthcare is a sector that always performs well. And then bonds, of course, bonds are definitely a safer investment. So I mean, my highest performing sector is actually healthcare.